morning. You're watching The Market right here on ET Now with me, Aisha Faridi, Nikunj Dalmiya, Avan Dabash as well joining in on the show. And the flip-flop for the equity markets continues. Well, it's been a roaring handover from US equity markets overnight. Nikunj, you can't get away from the volatility in our markets. I mean, call it whatever reason you may, the Adani Group stocks panic, the fact that the froth doesn't seem to be settling down over there, the poison is still not out of the system, but our markets are clearly in a very different trajectory.
So Aisha, we've gone through a patch of hectic news flow.
Yeah.
Budget, sell-off in Adani Group of companies, earnings, FI selling. Hopefully things will now settle down on the news front. So as now the budget adjustment, budget views, budget analysis, that's behind us. Markets know directionally which way the budget is going to move the economy. Second, you look at Adani Group of companies. Adani Group of companies, from a market standpoint, there are few things which matter. The collateral damage in the price, I think that's hard to call. Will they fall more or will they start bottoming out? Second, the earnings season. Markets have completely ignored mid-cap numbers, large-cap numbers. And today is again a big day for numbers because you got State Bank of India, which has been in performing stock, and then you got ITC. So purely from a market standpoint, I guess now markets will change gear. The budget adjustment is over. Adani Group of stocks, they will continue to hog all the limelight, but in terms of the collateral damage, what it had on the lenders, what it had on the banks, I think that also is getting marginalized because banks, they rallied yesterday. And third, I guess, is now what will happen to the aggregate big picture at the global level. So it will be back to basics, if I may so say the word, because it's just been a hectic news flow, puzzling stock trends, up and down in the market, too much of yes and no when it comes to price action.
Absolutely, and I'm just looking at the big tech earnings overnight that came out in the US equity markets, which, by the way, had a rip-roaring handover. But the guidance has disappointed for the big tech companies, be it Apple, be it Amazon, or for that matter, Alphabet. Meta has reported its first annual sales decline since its listing. Apple, the revenues are down about 5% on a year-on-year basis. They've generated $34 billion in operating cash flow, however, and Alphabet as well has managed to miss on earnings as well as revenue, as YouTube has actually fallen short of what markets were anticipating. Its posted just 1% growth for the fourth quarter of 2022. That's the calendar year that they follow. But having said that, it seems that a lot of price damage, Nikunj, at least for big tech companies, would be in the price. I mean, overnight you've got a 2.5% move coming in on the NASDAQ.
Yeah, Aisha, frankly, it's one of the phases of the market globally that markets always know what's coming next. So even though the numbers which we've got from big tech companies, they've not been very strong. There is a guidance cut. There are layoffs which are occupying all the headline. Most of the stocks, at least the big tech US stocks, they've actually rallied, and they've rallied in this year. NASDAQ has been an outperforming index. So from a market standpoint, it purely means that the worst of the price action in global tech, at least big tech, that is behind us. Will that have a spillover effect on Indian technology stocks, especially some of the growth and some of the product companies? Well, historically, we've seen that even though these companies are different, it's the trajectory which matters. And IT stocks post numbers, they've actually started outperforming. If you look at the YTD chart, let's look at it for the Nifty index and the Bank Nifty. The outperformance, I think, lies with the IT index, even though commentary by and large has been mixed. So that's the Nifty for you. That's yesterday's graph. That's this year Nifty is down 2.7%. Let's look at the IT index. The IT index, that's the Bank Nifty down 5%, and the IT index is up 6%. So the point I'm trying to say here is that even though big tech companies, they disappoint on the earnings front, Indian IT companies, they've disappointed and numbers have been mixed. IT as a group has started outperforming after almost a year of underperformance, and that is also coinciding with what is happening in US tech companies. Also, markets are nervous about companies which essentially have debt on them, given what's happened to Adani Group of stocks. So that pocket is underperforming. Markets are nervous about what will happen in case inflationary fear come back. So there is a change in the market template. Globally, big tech is making a comeback. Locally, some of the technology stocks are catching up.
Yep, that's being seen as a trend when it comes to the entire IT basket. But that aside, lots of news flow as well to focus on, and you've got the entire Adani group of stocks yet again in the spotlight. And remember, there's been a massive rout that we've seen across that entire group of stocks, but now the NSE has put Adani Enterprises, Adani Ports, and Ambuja Cements under ASM, which is additional surveillance measures effective, that framework effective February 3rd, Nikunj, in order to curb short selling.
You know, Aman, what is puzzling for me is that I was just purely looking at the volume action in Adani Enterprise. The Adani Enterprise stock yesterday saw volumes which were almost 6 times more than that of Reliance. And I'm using Reliance as a benchmark to establish, the data here. And that in a sense is very clear that right now there is rampant speculation which is happening in some of these stocks. Given the price action, volume action, there you see. That's the volume action in Adani Enterprises, 6 times more than that of Reliance. The free float of Reliance is 50% and the free float of Adani is only 24%. But the volume action in Adani Enterprises is 6 times more. Isn't that amazing? Now what the exchange has done is that they've increased margins, which means that if you're buying the stocks where the ASM margins have gone higher, and they could go higher if volatility does not subside, you will have to shell out more money. So if you're a short seller, you automatically will have to shell out more money, and similarly if you want to buy also on an intraday basis, you shell out more money. Could this lead to a squeeze, and could this curb the volatility? That is something what I think needs to be addressed, and this is a factor which really would be at play today when markets will open. The ASM adjustment will happen in some of the Adani Group stocks depending on the positioning of investors stroke traders here.
Yeah, absolutely. Okay. The two big numbers then, like we flagged off earlier on the show, SBI as well as ITC. Of course, ITC is going to be post-market hours, but SBI well within. And we are expecting both the NI as well as the PAT for SBI to jump on a year-on-year basis. But I guess for SBI, it's really all about the market positioning, Nikunj. I was looking at how many buy and hold, no sell, of course, on SBI right now. 96% of the analysts on the street have a buy on SBI.
Asha, SBI stock has, why did it fall from the top? It's nothing to do with economy, it's nothing to do with what is happening to the interest rate cycle or what is happening to the credit cycle. If at all, the budget has been a booster for them. SBI and some of the other lenders which have exposure to Adani Group of stocks, they fell because markets thought that if there are large exposures which some of the PSU banks have to Adani Group of stocks, if there's a collateral damage there, what will happen to the underlying book value? The management has come out and said that, look, we are not worried about that exposure, and from a market standpoint, that I think is getting interest. Now what we need to understand is that now that this entire issue that the Adani Group of loans are not a problem for India's biggest lender, you need to look at operational numbers. The surprise for State Bank of India last quarter was that the ROI went higher. Now ROI for State Bank of India for the quarter gone by was 1%. Will that momentum continue? What will happen to NIMs, and at what level the deposit growth is now leveling with what is happening in terms of the CASA growth? These are the factors which really matter. Optically, if you take a 1-year view, 1.5-year view, 2-year view, 3-year view, I think PSU banks are in a fine fettle. State Bank of India is in some kind of a leadership position. So that template does not change. It's a fine print which will just give you this 3, 4, 5% spike on Monday when markets will react to those numbers. Return on ROA, what will happen to the NIMs, and the CASA growth versus the deposit growth gap.
And then, of course, ITC, the darling on the street already. Cigarette volumes expected to be healthy. Of course, a favorable base is what's going to aid the hotel business as well. And, you know, that minuscule uptick of tax which was announced in the budget, I think analysts have already done the numbers and worked it out that it's not going to be a big move or a big impact on ITC, and it's not like it's going to impact their volumes or anything. It's just a very minuscule surcharge. That should not really tamper.
Yeah, the stock fell on the budget day.
Recovered and then was up massively yesterday.
Yeah. ITC is almost at a new high. Historically, we've seen that every budget has increased historically, traditionally, taxes on tobacco. This time around, the increase has been very minuscule. So it clearly means that the government now is not desperate to tax and retax the tobacco industry to get some revenue, which means that is the worst of the tax regime for tobacco as an industry behind us. If that is true, that's a mighty relief for a stock like ITC. Second, this is one stock where we know that the institutional ownership historically has been low. You take out 1 year of outperformance, that's about it. See, the bent of the market is such that markets are now gravitating back towards consumer companies where their visibility of cash flow. And fourth, I think their hotel business, which we always ignore, I think is in fine fettle. Look at what we heard from Puneet Chatwal. I mean, ITC also has got good hotels, and those hotels are they're expanding the hotel business. We don't talk about it. We always think that, oh, it's only Taj. No, ITC also has got a very decent portfolio. And they've really expanded. Go to their website, you'll see that there are some very nice fancy hotels they've opened. So the hotel business, cigarette tax, hopefully it's speaking out in India. And third, the market is gravitating back towards some of these consumer stroke companies which are giving you visibility on cash flows for next 2 or 3 quarters.
Okay, that's the view coming in on ITC. Both of these counters will very closely be watched when it comes to numbers. But let's hear it out from a top market veteran. Financials will continue to be one of the preferred sectors. That's Inam Group's Vallabh Bansali. He also calls the budget extraordinary, saying that the government has done a fine balancing act.
Financial sector will always be a favorite circle. So, whenever there are corrections in that sector, people will want to buy. Similarly, the whole consumption basket is going to be like that. If you asked me about balance sheet last year, I told you that, it is first time in several decades that we had all the 3 balance sheets in good shape, corporate, banks, and the government. The fourth balance sheet, which may be under some stress currently, is the personal balance sheets. And that's where the finance minister, listened very carefully and has given direct tax benefit. So suddenly, large number of people who were in tax bracket have gone out. It has a huge sentiment effect. If interest rates come down further, the EMI pressure comes down further, I think some of this stress, which may be there to some extent, will start correcting. One thing that we haven't seen is still the result of, crops. Some of the crops have done phenomenally. And, once that starts coming into this, so some of the stress that you may be seeing, one area where, real estate prices have gone up very high, and now you have some marginal change in real estate, taxation policy or, capital gains reinvestment policy. So maybe some of those cases, some pockets where real estate was very high, may see some corrections. So bade desh mein, choti baatein to kuch hoti rahegi. So except for those 3 balance sheets remain intact. I think the kind of dividends that will come out of banks is going to be staggering. Both to the government and, private sector. So bank after bank, is not talking of, any significant credit cost. And we have seen the expansion of NIMs in many banks. So even if on a larger base, some of these things get corrected, still there will be very, very healthy profits. So with government spending all of this with a reduced fiscal deficit, that is the most important thing. Therefore, any shortfall that could arise from any of these balance sheet stresses, if at all, is not going to be there. The fiscal deficit, the borrowing number, the conservatism in the estimates, etc., all give us confidence that this will continue.
Albotra and Naresh Mirani on the technicals then and find out what their views are on the markets and levels. Good morning, gentlemen. And Kunal, let's begin with you. As we've been talking about, the market really has been faced with a lot of news flow that it's had to digest. How do you think it's come out on the other side, given that we are quoting at around 17,600? And what really is the kind of volatility that we've seen indicative of?
Good morning, Avan. So I think we've been a lot more resilient when you look at the indices. So, when we look at the index, a 500-point correction from that 18,000 odd mark, we standing at almost 17,500, 600 levels on the index is still a kind of a mature price action from the indices, given the price action for the overall market breadth and specifically certain group of stocks. Now, the market breadth is something which is a very important factor which we keep discussing regularly, because that generally determines the health of the markets and the texture of the markets as such. And over the last couple of days, specifically from 30th of Jan, we've seen a dramatic change in the market breadth. The number of stocks which are actually trading below their 20-day moving averages, their 50 DMAs, they've actually dropped from the previous lows when the index had hit that 17,400 odd mark. So that generally indicates that even if the indices are going through a patch of volatility with no major sign of a breakdown below the 17,400 mark, the market breadth is actually improving. That's generally a sign that we expect that the markets would probably get into a bounce process. So we'd maintain the stance which I had initiated yesterday, a buy on dips. So if we have an intraday correction like 100, 150 odd points on the Nifty, that should be taken as a good buying opportunity.
Okay, Naresh, morning. Let's find out your outlook then. What are the levels that you're tracking on the index?
So the broader market, the broader view remains the same. 17,400, 500 should hold on. And if that hold on, we go towards the 17,900, 18,000 mark. And that is where the major resistance is. When we start crossing that, that is where the momentum changes in a big way. Same thing continues on the Bank Nifty. The recent lows should hold on. And once we start crossing 42,200 to 42,500, that's a time when the trend changes in a big way. And overall, what we are seeing is the global markets are in a very strong trend. So yesterday, the Nasdaq was up 3.5%. S&P 500 is above the 4,100 mark comfortably. Dow Jones continues to be at 34,000. US dollar index is closer to that 101 mark. So overall, the broader markets as well as globally, everything is on a positive territory. On the index, we are still not in a strong trend in India as such, but I believe we have started getting into a much stronger market. If we remove out the index, the rest of the stocks do look interesting because there is some impact of the Adani Group companies which continues. To give you an example, the Adani Group had 2% weightage and we've fallen from 17,800 to say 17,600, and a 50% fall on 2% weightage. It is almost the same hit and a little bit of impact coming on banks. But overall, the broader market looks interesting and we could be getting into a place where we start seeing more outperformance in the small caps and the mid caps.
Right, okay, let's talk stocks. Kunal, what's on your list?
So I'll go with a couple of buy calls. The first one is from the mid-cap space. It's one Voltas. I think the stock is forming a classical triple divergence, three successive price lows. But on these three successive price lows, the indicators have actually made a higher low for itself, and it's now giving a breakout on the indicator front. So that should result into a strong uptick for Voltas over the near term. Buy with a target of 880, stop loss at 780. And from the mid-cap IT space, it's ENT Technology Services, which is also looking very attractive. The stock seems to have formed a base closer to that 3,350 odd mark. So keeping 3,380 as a stop loss would suggest a buy with 3,580 as an immediate target.
Okay, and Naresh, what about your stock-specific strategies?
So first is a buy on Indigo. The stock has held on to that 2,060 to 2,100 mark all through the correction over the last 1 week or so. Has shown a lot of relative strength, has a short-term breakout, a flag breakout about 2130 to 2150 levels. Once that happens, it could be looking at a move towards a new all-time high as well. Expecting a target price of 2,300 and a stop loss at 2,050. Second is a buy on Ashok Leyland, which is a buy with a short-term to medium-term view as well. The stock has consolidated around that 145 to 153 mark, trying to make a breakout move above 153. Post the result, the volumes have also been good in the last two sessions. So volume action and price actions is pretty decent. Expecting a move towards 170 plus, a stop loss at 144.
All right, there you have it. Those are some top recommendations from our chartists. All right, let's move right on and connect with Mahabaleshwara MS, who is the MD and CEO at Karnataka Bank, to talk about the jump in the profits as well as a healthy NII growth. Thank you so much for taking time out. Now, just walk us through the outlook in terms of Karnataka Bank, in terms of how you are looking at your overall deposit growth. Because it seems like everyone is chasing deposits with deposit growth trailing advances growth. What is your outlook?
Yeah, very nice. See, madam, if you just go through the overall performance of our Karnataka Bank for the Q3 of the current financial year, I must say that it has not only been impressive but also consistent. There has been a consistent and continuous effort to ensure a quality business and to further improve the fundamentals. When I say the quality business, as you have rightly pointed out, yes, banks are facing the liquidity related issues. But for us, as our CD ratio is somewhere at around 73 to 75%, we have not yet facing that type of issues. But fortunately for us, our CASA is growing well. In fact, it has grown at a rate of around 9.95%. And as of now, my CASA is at 31.91% as against the 31.30% corresponding previous year. Credit growth is slightly higher than that. It is at 19.51%. So YOY. And of course, the quality has been one area, the asset quality, that has been engaging our attention. And in that area also, we have been able to further improve our position. In fact, our GNPA, which was at 4.11% about a year back, is now at 3.28%. So also the NNPA, which was at 2.45% at 1.66%. In nutshell, what I am highlighting is that the earnings have improved significantly. That is, NII has shown a growth of 34.07%. Operating profit has also recorded during this particular quarter a growth of 49.27%. This is as far as the quality business that we have been focusing. In the past also, I have shared with you, with your channel as well as to our investors, that we have been consistently focusing on the fundamentals. All the fundamental ratios, I must say that, are at a new high.
No, that's understood. But I just want to, move further and get in more perspective on your numbers, because your cost of deposits and cost of funds haven't inched up compared to your pre-COVID levels. Are you seeing a meaningful increase, and how is that going to impact your NIMs?
Yeah, see, cost of deposit, some upward movement is there, but it has gone up by cost of deposit is gone up from to 4.54% as against 4.46% as of September. So September to December, it has gone up by 4.46% to 4.54%. As far as the yield on advance is concerned, it has gone up from 9.24% to 9.45%. So that being the case, so the yield on advances, the increase in the yield on advance is much higher than the cost of deposit. So we have been able to maintain our spread as far as the returns are concerned.
Fair point. But does this also factor in your yields? Your yields are steady in a rate hiking cycle. What's the reason behind that?
Yield on, see, there were certain areas of reversal of the interest also. So that is maybe one of the things. But in the current month, that is during the January and onwards, it has started improvement in the yield aspect.
Okay. I want to specifically talk about your loan growth as well, which has come in at 12.5%, which is also well below, one would say, the system or the industry growth. Are you being cautious? And then what is your FY23 as well as 24 guidance?
All bankers would love to be cautious, because it is definitely not a time for an aggressive exposure. But we are taking utmost care. Especially that is the reason why our stress in the portfolio is also coming down. That doesn't mean that we are over cautious. I should say that we are reasonably aggressive as far as the credit side also. In fact, I have been focusing more on the agricultural credit, which now constitutes about 16.12% of our GBC, with an YOY growth of around 9%. Contractors exposure also, because a lot of infrastructure related activities are happening. So our growth rate has been at around 16.25%. Infrastructure is one area. Of course, as far as infrastructure contribution is concerned, it is constituting around 1.92% of our loan book. but last year we have grown at a rate of 37.69%. Being a South-based bank, I'm also more focused on agri-gold, where the growth rate has been 8.38%. So, of course, along with that, the car loan, home loans are other areas. So, wherever we find that there is a good growth opportunities, we are taking the informed credit exposure for those particular sector. And going forward, as I have already said, of course, even though for the current year it is the 12.51% growth, for March, I am optimistic that we will be able to surpass minimum 15% YOY growth in the credit as well.
Mr. Mahapalish, a pleasure having you on the show today on ET Now. Thank you so much for taking the time
Thank
out.
you.
Let me now welcome on board Keki Mistry, Vice Chairman and CEO at HDFC, to talk about how their numbers panned out. Keki, hi, morning. Your AUM growth has come in at 13%, which is slightly lower than what we expect of HDFC. Is that a conscious call or non-individual not growing?
So when we would target loan book growth, we always target individual loan book growth. If you go to see now, our individual loan book growth has been over 18%. I think it's 18.3 or 18.4% or something. Non-individual loan book comprises mainly three components: corporate loans, construction finance loans, and LRD loans. Now, in that three segments, construction finance is the largest segment. Now, construction finance loans, what is important to understand is that it is the disbursement is linked to construction. Now, when a developer launches a project in a city like Mumbai or Delhi or Bangalore, any of the big cities, these are usually large projects. And these large projects take 4 or 5 years to complete. So the disbursement starts maybe 1 or 2 years after the loan was approved, because by that time all his other approvals are received. He puts in his own contribution and then we start disbursing. So disbursements always tend to be back-ended and never front-ended. Now, the period from 2017 to 2020 was a period when there was stress in the real estate sector. And consequent to that stress, there were not too many new projects that were launched. What we would otherwise be disbursing now, typically, would have been projects which were launched in 2018 or 19 or 20, when project launches were very, very slow. Post-2020, post the second half of 2020, the real estate sector has really picked up, demand has increased significantly, and a number of new projects have started getting launched. So 2021, 2022 saw a fairly large number of new projects coming in. Now the disbursements, so the pipeline is healthy, but the disbursement for these loans will only come over a period of time and not upfront. But individuals is what we've been targeting, and there our target, what we tell investors, is a 12 to 18% growth. We grew higher than the 18% target, marginally higher, about 18.3, 18.4%, which is higher than the system growth. The system growth based on the RBI number, which I think came out a couple of days ago, is about 16.2%, 16.1 or 16.2%. We grew 18.3, 18.4%.
Mr. Mistry, hi there, morning. Now, there's obviously a lag between your asset and liability repricing. So going forward, how should one look at the timing of the unwinding? And also, with the RBI policy coming up, do you think we can see interest rates inch up? What's your outlook in terms of where you see rates headed?
All right. So whenever interest rates increase or decrease, the liabilities increase or decrease immediately. We also increase the PLR or what we call the retail prime lending rate, which is applicable to individual loans. But the agreement that we have with individual customers up to very recently said that the interest rate resets once in 3 months. So it's not every month that the rate resets. So if you had taken a loan, for example, in the month of January, the rates will reset in January, April, July, October, and so on and so forth. So if a rate change happens, let's say in the month of November, then it will be applicable to you only in January. So effectively what it means is there is a 3-month period by which the entire interest rate increase or decrease gets filtered into the system. So if there is no further increase in interest rates going forward, then rates, you start seeing the upward movement in the yields. But if again there is a rate hike, again it will take that 2 months, 3 months for the yields to sort of settle. My personal view is that inflation is now pretty much under control. Globally also, we've seen that oil prices have corrected quite a bit. So given all of that, my sense is we will not need to do too aggressive interest rate hikes going forward. And in my personal view, 90 to 95% of the rate hikes that would have happened have already happened. And I would personally see maybe another 0.25% increase in interest rates as a possibility, but not much more than that.
Okay, now as you walk into trade this morning, what should be the market view? First, Keki, first, thank you very much. And we'll talk about markets. As we walk into trade this morning, what should be the basic underlying theme? We've seen a hectic news flow, budget, sell-off in Adani group of stocks, the impact of that on lenders. Globally also things have been slightly haywire given that in middle of the week we also had an FOMC. So purely from a market standpoint, I expect the news flow first to reduce, which means bulk of the budget adjustment is behind us. What has happened in Adani group of stocks, underlying I'm talking about the stock prices, it's very difficult to call whether they will bounce back or not, but for sure they will remain volatile. But the domino effect of Adani group of stocks was felt in some of the lenders. So the lenders sold off. And that's where I think some rationality and some logic is coming back, whether it is State Bank of India or whether it is government officials or whether it is LIC, everyone's come out and they've said and indicated that look, Adani group of stocks are unlikely to have a systemic problem, at least for the lending system per se. So you've seen a comeback in some of the PSU banks, which I guess is very, very important. So that's part 3. Part 4 is the setup of the market. The setup of the market is that Nifty is, I think, reasonably holding on despite what has been thrown at it. With this kind of a news flow, you could have really broken below key levels. FIs were sellers for one big day, but after that, they've not been selling hard. And then in middle of the earnings season, markets now progressively will start looking at companies where there has been a beat or where there has been a miss. So the market now will start moving out of technical, compulsive and other news-driven factors to what the normal market is. What is normal market? Technicals, flows, liquidity, earnings. I think we are going to that market once again. Give this market some days, things at least on the margin looks like they are settling, and more than this news driven fear psychosis which had gripped the market, my sense is that will rationalize. Sandeep Sabharwal, good morning.
Morning.
How are you feeling today?
All good, very good.
Would you agree with my assessment? Did you play squash?
Because of this show, I can't play on Friday.
Okay, good. So now that we've convinced you not to play squash, we're just talking about the fact that we are in the middle of this mad week of news flow. FOMC, earnings, Adani sell-off, technicals, FI selling. I mean, it's like saying that एक साल का news flow एक हफ्ते में हो गया.
Yeah, that's true. It's a tsunami, but actually, Nikunj, it's so intriguing. I was looking at the data of 52-week highs and all. So there are so many good companies which are actually hitting 52-week highs, also driven by strong performances, and some very contrary to the market movement. Some of those stocks I also don't own, like, for example, something like a Blue Star, where Voltas is in doldrums. Blue Star is doing so well, while the rest of the IT stock mid-cap companies are so far away from their all-time highs. KPIT Tech is near all-time highs. So I think it's all how the companies are performing, how they are doing, and I think those companies are getting disproportionately rewarded and will continue to get disproportionately rewarded because only few companies are doing very well, and rest of the companies are faltering in terms of what people's expectations are and what the delivery actually is.
We can't move too much away from Adani group of stocks. I'm analyzing the news, Sandeep, and I would request you to stay with us and let's try and understand the news here. First, lenders, they sold off. Markets got this fear that, okay, Adani Group is a leverage group, banks have a large exposure. Banks have come out and said that everything is under control. Do you think the fear in PSU banks, because they have exposure to Adani Group, was slightly overdone, and that should be the first go-to pocket now?
See, I don't have access to Adani's financials and the cash flows, etc. But it's so any default or any risk of repayment, etc., will not happen immediately in any case. Just because the stock market fell, it's not that the company will stop repaying its debts, etc. So we need to analyze it over time. Now, secondly, you rightly said the group is over leveraged. Now, how they control their future expansion plans so as to not put more risk into their stocks and the entire group is something we need to see. So that's for the management to do. But the problem, I think, started and continues to be with the overseas bonds. First of all, I don't understand why they've issued so many overseas bonds when they are largely a domestic company and dollar denominated or whatever currency they are denominated in. So yields are moving up, so refinancing risk comes in. You lose due to the depreciation of the Indian rupee, etc. And the kind of yields those bonds have started to trade at, that's creating fear in the minds of equity investors also, because those bond yields have become quite abnormal. Some of those bonds, not all of them. So I think that's where we are. It's very tough to analyze. Some of the companies of the group will do well. For example, they took over Ambuja ACC just now. So if we have to dispassionately analysis, those companies on a standalone basis will do as well as any other company in the cement industry will do. Whether a sell-off of 40-50% from the top is justifiable and whether those are providing opportunities, so that's for individual investors to decide.
Sandeep, hi, good morning. What's the view on ITC? Perched at those record highs, you did have some tinkering in the taxes for cigarettes, but analysts believe that this can very easily be passed on. It's absolutely minuscule. Of course, today we'll be eyeing the company with a magnifying glass largely on the back of its quarterly numbers. But do you sense that with some of these, tax concerns now behind us, that there is more scope for growth for ITC, which is already in a nice sweet spot?
Going into the budget also, I don't think that was the risk playing in the minds of investors. Again, I come back to the same point. It's a matter of few companies performing. For example, if you look at the entire consumer basket, there are companies which have not delivered good results among the fancied ones like Asian Paints or Titan or Pidilite, etc. So many companies have not done well. HUL came into its own issues related to the royalty payment. But so then some companies are doing well. And once that is happening, those companies are getting disproportionate interest. For example, something like Britannia did very well. There's expectation ITC will do well. There's no reason why the result shouldn't be good, because even X of cigarettes, FMCG, their hotels, as well as paper business, all of them should be delivering good results. So I think that's what is happening in the markets. Now, rest will also depend on how the results come out, because run up to the results, the stock has done very well. So if results are good, it will sustain. If results are not good, then it might go into some sort of sideways hibernation for some time.
Okay, let's go across to Vinny then, who tracks the company, and she joins in to give us a sense as to what exactly the ET now poll is penciling in terms of cigarette volume growth, the outlook on the hotel business, as well as the headline numbers for ITC. We seem to have snapped that link. But in the meantime, Sandeep, wanted to get in your thoughts on the entire IT space. Just earlier this morning, we were talking about the kind of rout that we've seen in some of the global tech majors, largely on the back of these companies missing their earnings estimates. But how the outperformance now, once again, in the Indian IT space is returning. Would you concur with that?
Yeah, in fact, many of the global IT companies have also come back so fast. If you look at something like Meta, it went to $90 just 4-5 months back. Yesterday, it was $180, 100% rise in just 4-5 months. Now, IT, I've been largely underweight. but what's playing out is the possibility of a soft landing rather than a recession. So a soft landing, if actually it turns out that inflation gets controlled with a soft landing, then my hypothesis of the companies having a greater decline in their earnings growth, etc., could not play out. So they might actually do better. So I think that's something we need to watch out for, and that's what I think that's what the market thinking also is right now. And as a result, these companies are outperforming despite not such a great outlook at this stage.
See, what a comeback it's been for IDC. Exactly a year ago, nobody liked it. Now everybody loves it. Cigarette, there's a price hike in cigarette, but duty hike in cigarette, but markets are saying it's minuscule, it's time to move on. And the fact that the taxes on tobacco and cigarette, they are now going low, but they're going up in a minuscule manner. It means that perhaps worst of the high tax regime for tobacco, I think, has peaked. Also for ITC, the hotel business, we always think ITC, cigarette and FMCG, but they have a paper business which is in a bull run. They have a hotel business which is in a bull run. And I think that's what Vinny would outline, because the preview clearly seems to be pointing to decent growth in cigarette, good growth in FMCG, and uptick in the hotels.
Absolutely, overall that revenue growth 6%, and hotel business surely something that will be supporting the overall growth of the company as well, because tourism was back, travel was back. So hotel business is expected to see a very strong growth coming in as well. And do not forget, there was a favorable base also which is coming into play. Even the non-cigarette FMCG business is expected to see a 15% growth coming in. And overall, when you talk about the cigarette business, cigarette volumes are expected to be above that pre-COVID levels. 8-9% is what we're expecting the cigarette volumes to come in at. Now, even in terms of the margins of the company, margins mainly are seeing an expansion coming around 200 basis point expansion in terms of margins, mainly owing to the improved sales mix. Other than that, the operating efficiencies as well as the price hikes that the company has taken in certain segments, that is supporting the margins of the company as well. So all in all, we're expecting a decent set of numbers coming in from ITC this time around. Focus is going to be on as commentary, anything coming in on the cigarette volumes, the mix improvement over there, as well as the FMCG EBIT margin is an important one that we're keeping an eye out on in terms of numbers as well. And outlook coming in from the agri-business, hotel business, as well as the papers business of the company.
Thanks very much, Vinny, for putting that into perspective. We'll be watching out for ITC and trade. But let's get in some top fundamental stock recommendations. And Dipan Mehta, he talks about his top idea. Listen in.
The merger, I think, has been in the works, but it's just getting delayed. But there's no denying the fact that the underlying fundamentals of IDFC First Bank have significantly improved. Do a quick comparison. I think it is a winner on all fronts, whether it is deposit growth rate, CASA, net interest margin, profit growth, improvement in the balance sheet quality. I think across the board, when you compare IDFC First to its peer group, it's a clear winner. The stock is at a reasonable valuation, very aggressive management. And I think that amongst the banking stocks, it is our top pick, usual disclosure that we and our clients are invested, and should clearly outperform the bank nifty and some of the other larger private sector banks and maybe a few of the PSU banks as well. So that is one stock that we're very positive on.
Okay, moving right on then, let's find out what exactly is in store for SBI. And Sandeep, get in your thoughts then on what exactly you're expecting when it comes to the quarterly performance from SBI. How you've seen as well the PSU major shaping up, and what your outlook is, given the fact that we're expecting this time around a pretty healthy profit growth. We're expecting as well that, the net interest income could come in higher by about 24% on a year-on-year basis. Your take?
Yeah, I think like most large banks, it will outperform on net interest incomes because of the huge CASA franchise. So I think that's not an issue. Profitability growth should be good. What we'll need to watch out for is the commentary on NPAs, etc. So I think whether there's some uptick or not, for most banks it's not been there, but SBI went aggressive on lending much earlier. So whether there's some impact out there, and obviously their commentary on their Adani exposure, etc. Because there are so many figures being floated around, no one really. So I at least don't know what that exposure, etc. is, and that's what has been acting as a barrier on the performance of this stock.
10 minutes. Where is SGX? SGX is up 100 points. Are we in for one of those thank God it's Friday kind of a rally? Duresh, are we in for a TGIF rally?
Ideally, it should be, given that what has happened to the markets yesterday globally. We saw a 3.5%
A rally and there is no zing in your voice. Come on.
So
it's
I would
Friday and rally. They both two
yeah.
things should put a spin in your voice.
So you don't count your chickens before they hatch. So you wait for it.
So wait for a TGIF. Kunal, TGIF rally?
Yeah, TGF rally.
100 points, 200 points?
100 points on the Nifty.
Bank Nifty?
Well, you multiplied by 3.3 times.
Okay, so Kunal is of the view that we are in for a TGIF rally. Sandeep Sarwal, are we in for a TGIF rally?
It's possible because of the restriction. Because as it is, see, things were not bad. Things are not bad. It's just that the travails of what's happening with the Adani Group are playing on the Indian market. So I think markets look okay to me, and I think some of the financials could come back. Auto companies are doing well, capital goods. So I think there's nothing negative per se.
100 points higher for the SGX. Are we in for a TGIF rally? Thank God it's Friday, I'm telling you guys. It's just been such a busy week. Budget, FOMC, Adani FPO. First it got subscribed, then the withdrawal, and then so many reactions are pouring in that it's absolutely amazing. Too many opinions, too many numbers, too many views, too many yes and no's which currently are there in the market. And then if that was not enough, I mean, we're talking about Adani and banks and budget and capital gain tax. The real rally, Sandeep, has happened in IT. The index is up 6% this year.
Stocks have outperformed significantly, and like we were discussing, because of the possibility of a soft landing. If there's soft landing, then I think their outlook is not bad. But my assumption was that we'll see a recession because of the rate hikes. But I think all the data is pointing towards a soft landing at this stage. Maybe we'll have a recession also. So I think that improves the prospects for IT companies. Also, they are very correlated to NASDAQ movements and the way the NASDAQ has rallied. So that's also having an impact on IT.
Okay, that's the view coming in. Let's hear it out then and take it across to my colleague Harsh, who joins in with the ET Now poll as to what to expect from SBI, what we're expecting in terms of the jump in profit, the NII growth, as well as what exactly the street is penciling in. Harsh?
Well, SBI will come out with its numbers. You're expecting net interest income at around 38,000 crore. That's a sharp sequential uptick, 24% when I'm looking at it year on year. Operating profit too will go up by around 24% year on year. Provisions will see an uptick when I'm looking at it sequentially on a quarter on quarter basis. But we have to keep in mind that in Q2, the provisions came in at the lower end of the stick. So we're looking at 3,000 crore of provisioning, which is a very, very low base. So we are expected to see that go up to 4,500 crore odd. We're looking at profit after tax, therefore, of 13,500 crore, pretty much flat sequentially. So definitely a solid performance overall. We're looking at a 60% growth on a year-on-year basis in terms of PAT. NPA is expected flat, no surprises at least expected there. NIMs are expected around that 3.5% mark. Keep an eye out on deposits, because as deposit rates start getting repriced, that will start impacting NIMs, and commentary around that will also be important. Gross advances are expected to go up 20%, very solid growth there, 4.5+% on a quarter-on-quarter basis. Deposits too, to match around 3.8% quarter-on-quarter, 13% year-on-year. That's where the deposit number is expected to come at. And of course, the loan growth traction is what will keep SBI in the news, hopefully. Margin guidance going forward will be an important piece of the puzzle, as I did mention, with regard to deposit rates. So keep an eye out on all of these things from SBI.
Yes, we certainly will. Thanks very much for giving us those details on SBI. Meantime, then, Sandeep, wanted to get in your thoughts on some of those insurance stocks. Of course, we did see the impact of the budget play out on some of these stocks, but brokerages are of the view that perhaps the reaction was a bit overdone. Your take?
Yes, I think it's still, the jury is still out on the actual impact of what will play out, but it was a definite negative. So I think the reaction of the stocks was natural. So 10-15% call on a potential slowdown of 4-5% of business is not wrong. So overall, directionally, long-term insurance is a decent sector in India, given the fact that the penetration still has to improve and there are still growth prospects. So I think stocks could stabilize around these levels, but I find it tough to see them outperforming.